Mutual funds are the easiest way to invest without picking individual stocks. They're literally baskets of investments that let you own hundreds of companies at once. And you don't need to be rich to start. Some funds have zero minimum investment. The best performing mutual funds right now? FSELX, Fidelity Semiconductors, with a crazy 31% 5-year return. Tech funds are dominating the top spots because, well, tech is crushing it. But here's what most people get wrong. Chasing last year's hot fund is usually a terrible strategy. Past performance doesn't guarantee future results. Isn't just a disclaimer, it's financial wisdom. Instead, focus on these 3 things when picking mutual funds. First, fees matter more than you think. Look for expense ratios under 1%. Lower is better because fees eat into your returns over decades. Second, decide between active or passive funds. Active funds have managers trying to beat the market and charging you more. Passive funds just track an index like the S&P 500 with lower fees. Third, consider your time horizon. Younger investors can handle more stock-heavy funds. Closer to retirement, you might want more bond funds for stability. You can buy mutual funds through any brokerage account or directly from companies like Vanguard. Most 401ks already offer them. The real secret to mutual fund success: consistency. Set up regular investments, diversify across a few good funds, and let compound interest do its thing over time. That's how average people build wealth without becoming stock-picking experts.